It's late at night. The kitchen is quiet. The lights are off in the rest of the house, and everyone else has already gone to bed. You have a steady paycheck. The mortgage is paid off or close to it. There's money in savings. This month's bills are covered. Nothing urgent is happening. Still, you open your banking app, you check the balance. Then you check your retirement account. You calculate how many months you could survive if you lost your job tomorrow morning. You mentally subtract health insurance, property taxes, groceries, repairs, and the possibility that one of your adult children might need help. The numbers say you're doing fine. Your body doesn't believe them. Someone in your family may have told you that you should relax. Take the trip. Replace the old couch. Work fewer hours. Enjoy what you spent decades building. But your answer comes automatically. You never know what could happen. From the outside, this looks like responsibility. Maybe caution. Maybe pessimism. Maybe an inability to enjoy success. But what if you're not really checking how much money you have? What if you're trying to reduce a feeling of vulnerability that returns no matter what number appears on the screen? For some members of Generation X, financial security has never meant simply having enough. It has meant constantly preventing enough from disappearing. And that creates a strange psychological problem. You can become financially stable without ever feeling safe, because objective security and the experience of security are not the same thing. Two people can have nearly identical incomes, savings, homes, and retirement plans. One feels grounded. The other feels as if the entire structure could collapse after one bad year, one illness, one layoff, or one decision made by someone else. The difference isn't always in the math, it's often in what money has come to mean. For one person, money is a resource. It allows choices, comfort, generosity, and pleasure. For another, money is a shield. It is distance from humiliation, protection from dependence, the ability to leave a bad job, survive a broken relationship, handle a family crisis, or avoid asking someone for help. The balance in the account is not just answering, "What can I afford?" It's answering a more emotionally loaded question. How long can I survive without needing anyone? That question does not come from nowhere. Generation X is not one personality type, and no single story explains everyone born within a certain period. Some people grew up with stability, reliable support, and a healthy relationship with money. Others experienced chaos that had little to do with their generation. But for part of Gen X, the environment taught a particular lesson. Structures that look permanent can change without warning. Jobs disappear. Industries change. Companies reorganize. Pensions become uncertain. Technology makes entire skills feel replaceable. Housing markets rise and fall. Marriages end. Parents become overwhelmed. Institutions that seem solid reveal how quickly their promises can be revised. Even when you don't personally experience the worst version of these events, watching them happen can shape you. A father loses the job everyone assumed he would keep until retirement. A neighbor sells the house after a financial crisis. An adult at the kitchen table whispers about bills, believing the children aren't listening. A company rewards loyalty for 20 years, then eliminates a department in a single meeting. A family that once appeared comfortable suddenly starts cutting back. The lesson is rarely spoken directly, but the mind absorbs it. Do not assume stability will continue just because it exists today. This is how security can stop feeling like a condition and start feeling like a task. You don't have security, you maintain it, you protect it, you monitor it, you earn it again every morning, and if you stop paying attention, something may take it away. Psychologically, this makes sense. The brain doesn't only learn from facts, it learns from repetition, observation, emotional intensity, and the consequences attached to events. If uncertainty repeatedly appears around employment, money, family, or support, you become more attentive to signs of instability. That attention can be useful. You notice risk early. You prepare, you save, you think ahead. You don't assume someone else will solve the problem. These are real strengths. They may be part of the reason you built the life you have now. But the same system that helps you prepare for danger can struggle to recognize when the danger has changed. Imagine a child who learns not to ask for much. Maybe the adults are busy, stressed, emotionally unavailable, or dealing with problems the child cannot understand. The child begins solving things alone. They make their own food, handle their own schoolwork, keep worries private, avoid becoming another problem for the family. People may praise this child for being mature, and the praise feels good. You're so independent. You never need anything. You can handle yourself. Over time, independence becomes more than a skill. It becomes an identity. The child doesn't just believe, I can solve problems. They may begin to believe, I am safest when I don't need help. That belief can travel quietly into adulthood. Now the child is 52. They help their parents, children, coworkers, siblings, and friends. They lend money, cover emergencies, give practical advice. Step in when something falls apart, but when they need support, something changes. They feel embarrassed, irritated, exposed. Receiving help feels less comfortable than giving it. Depending on someone feels like losing leverage, and this is where money becomes psychologically powerful. Money reduces the number of situations in which you must rely on another person's generosity, patience, loyalty, or permission. It allows you to leave. It allows you to refuse. It allows you to wait. It allows you to say, I'll handle it. That kind of autonomy can be deeply healthy. A financial emergency fund is not a pathology. Avoiding unnecessary debt is not a symptom. Planning for retirement is not evidence that someone is living in fear. The question is not whether you save, plan, or prepare. The question is what happens inside you when you imagine not doing those things perfectly. Could you adjust your plan without feeling that you had become irresponsible? Could you spend money on something meaningful without mentally punishing yourself afterward? Could you rest without feeling that you were falling behind? Could you accept support without feeling weaker? Healthy caution tends to be flexible. It responds to current reality. Defensive vigilance is more rigid. It continues even when the circumstances have changed because its real purpose is not financial planning. Its purpose is emotional regulation. Checking the account creates a moment of relief. Running another retirement calculation creates a temporary sense of control. Rejecting a purchase prevents the discomfort of watching the balance decrease. Working another year delays the frightening moment when income may depend on assets rather than labor. Each action reduces anxiety in the short term, but that relief can reinforce a deeper belief. It was good that I checked. It was good that I didn't spend. It was good that I kept working. Something bad might have happened if I had relaxed. This is how vigilance maintains itself. Not because disaster keeps occurring, but because preventing imagined disaster feels like proof that the vigilance is necessary. You may never know whether checking the account protected you, but your nervous system remembers that checking made you feel better. So you check again. And then something else happens. The definition of enough begins to move. At first, you tell yourself you'll feel safe after paying off the credit cards. You pay them off. The relief lasts for a while, then safety becomes having 6 months of expenses and savings. You reach that number. Soon, 6 months feels fragile. A serious illness could last longer. A job search could take a year. The house could need a new roof, so the new target becomes 12 months. Then the mortgage must be paid off. Then the retirement account must reach a certain number. Then you start worrying about inflation, long-term care, helping your children, supporting aging parents, market losses, taxes, or living longer than expected. Every achievement solves one visible problem, but the internal system produces another scenario. This doesn't necessarily mean the concerns are irrational. Many of them are real possibilities. The problem is that possibility has no natural endpoint. There is always another risk. No amount of money can guarantee that nothing painful, expensive, or unpredictable will happen. So, if your emotional goal is complete certainty, the financial target will keep moving forever. This is partly explained by adaptation. What once seemed like abundance gradually becomes normal. The first time you see a certain balance in your account, it may feel extraordinary. A year later, that same balance feels like the minimum you should maintain. The mind updates its expectations, but it doesn't always update its sense of safety. You become accustomed to the resources while remaining alert to the threats. The result is a strange imbalance. What you have becomes invisible. What you could lose becomes vivid. And because loss is imagined emotionally, not just mathematically, a financially manageable expense may still feel like danger. This is why a person can spend hours researching a relatively small purchase they can easily afford. They aren't only comparing features, they're trying to make the decision feel impossible to regret. It's why someone may keep an unreliable car for years even though replacing it would not threaten their finances. It's why a vacation can produce more anxiety than anticipation. It's why a person with a strong retirement portfolio can still imagine retirement as a cliff. The money leaving the account is visible. The life gained through spending it is uncertain. And when your nervous system prefers control, visible loss often feels more significant than potential joy. This pattern can also reshape work. For many people, work is not only where money comes from, it is where evidence of competence comes from. You know how to solve problems. You know how to become useful. You know how to survive change by staying informed, productive, and difficult to replace. Every crisis you handle strengthens your sense of self-efficacy, the belief that when something goes wrong, you can do something about it. That is an important form of confidence. But confidence can become conditional. Instead of believing, I can handle problems, you begin believing, I am valuable because I handle problems. Then rest becomes psychologically complicated. Reducing your workload doesn't just reduce income. It can feel like reducing your usefulness. Delegating doesn't just share responsibility. It can feel like surrendering control. Retirement doesn't just mean leaving a job. It can mean losing the daily proof that you are still capable, needed, and protected. So you keep working. Maybe you tell yourself it's only for another year, then another. You may have enough money, but you don't yet have enough permission. Permission to stop proving that you could survive another collapse. This is why the question, can I afford to retire, is sometimes only the surface question. Underneath it may be, who am I when I'm no longer producing? Will people still need me? Can I trust my plan if I'm not actively earning? What happens if I become the person receiving help instead of providing it? And perhaps the most uncomfortable question, if I slow down, will I finally feel everything I've been managing through constant activity? None of this means that every hardworking Gen Xer is secretly afraid. Some people genuinely love their work. Some prefer simplicity. Some dislike spending because their priorities are elsewhere. Some save aggressively because freedom matters more to them than consumption. The same behavior can come from completely different psychological places. Two people can refuse the same expensive vacation. One feels calm. They simply value another goal more. The other feels immediate tension. They imagine medical bills, layoffs, market crashes, and family emergencies. Even after deciding not to go, they continue thinking about whether they made the right choice. The action is identical. The emotional process is not. One choice expands freedom. The other maintains the feeling that freedom must be postponed. That distinction matters, because a life organized around future protection can slowly become disconnected from the present. It was meant to protect. You may delay travel until work becomes less demanding. You may wait to enjoy the house until the renovations are complete. You may postpone hobbies until retirement. You may tell yourself you'll become more generous after reaching the next savings target. You may promise that you'll finally relax once your children are stable, your parents are cared for, the market is calmer, the economy feels predictable, and every major risk has been addressed. But life rarely delivers a moment when all uncertainty disappears at once. There's no official announcement saying, you have now prevented every possible loss. You may begin living, so the guard stays up. And the costs are often invisible because vigilance looks so much like virtue. It looks like discipline. It looks like sacrifice. It looks like being the responsible one. But your partner may experience it as distance. Your children may experience it as control. Your body may experience it as exhaustion. You may experience pleasure as guilt because enjoyment does not look productive. You may hide your fears from the people closest to you because sharing them would mean admitting that you don't have everything under control. And sometimes the person who protects everyone becomes the person no one knows how to protect. This creates a quiet contradiction. You build financial resources so you will never be trapped. But the need to protect those resources can become its own kind of trap. You build savings to create choices. Then fear makes every choice that reduces the savings feel dangerous. You work to gain independence. Then the identity of being a worker becomes difficult to leave. You avoid dependence to preserve freedom. Then intimacy becomes harder because intimacy always involves some form of reliance. Eventually, the central question is no longer, how much money do I need? It becomes, what do I believe the money must prevent? Must it prevent embarrassment, dependence, regret, a loss of status, the possibility of becoming a burden, the experience of being caught unprepared, the feeling that someone else has power over your future? Your answer reveals more than the number in your account. Because sometimes a person is not trying to accumulate enough money. They are trying to accumulate enough control to make vulnerability impossible. And vulnerability cannot be eliminated. You can reduce financial risk. You can insure your home, diversify your investments, maintain savings, and prepare for emergencies. But you cannot create a life in which nothing changes, no one disappoints you, your body never needs care, the economy never shifts, and you never have to trust another person. The attempt to eliminate all vulnerability does not produce safety. It produces permanent preparation. So what would a broader form of security look like? It would still include money. Objective resources matter. Savings matter. Planning matters. Access to health care, stable housing, manageable debt, and retirement income matter. But security can also include the confidence that you can adapt. It can include people you trust. It can include the ability to ask for help before a crisis becomes unmanageable. It can include skills that remain valuable even when a job changes. It can include the emotional flexibility to revise a plan without interpreting revision as failure. Security is not believing that nothing will go wrong. It is believing that when something does, you will not face it with only a bank balance and a locked jaw. This is where a small pause can reveal a lot. The next time you automatically reject a purchase, a trip, a day off, or a change in your workload, don't force yourself to say yes. Just notice the first story your mind produces. Is the choice genuinely inconsistent with your priorities? Or does it violate an old rule about what responsible people are allowed to do? Does spending the money threaten your financial stability? Or does it threaten the identity of the person who is always prepared? Would accepting help create a real risk? Or would it simply place you in a role you learn to avoid? And when you imagine slowing down, what exactly are you afraid will happen? Maybe the answer is practical. Maybe the numbers truly do require caution. But maybe the strongest fear is not running out of money. Maybe it is no longer feeling necessary. Maybe it is trusting a future you cannot supervise. Maybe it is discovering that you learned how to survive instability but never learned how to inhabit stability. This is not an invitation to become careless. It is an invitation to update the strategy. The vigilance may have served you. It may have helped you survive layoffs, recessions, family crises, unexpected bills, and years when no one else seemed prepared. It may have built discipline, independence, and remarkable resilience. You do not need to insult that part of yourself in order to change your relationship with it. You can thank the part that learned to prepare, and then ask whether it still needs to control every decision. You can keep the emergency fund and take the trip. You can value independence and still receive support. You can plan for retirement and allow the present to contain pleasure. You can remain responsible without treating relaxation as negligence. You can recognize that using money to support your life is not the same as failing to protect it. Now return to that kitchen. The house is quiet. The phone is still glowing in your hand. The balance hasn't changed. But perhaps the question has. Instead of asking only, how long could I survive if everything disappeared? You might also ask, what is this stability supposed to make possible while it is still here? Because money can be a wall, but it can also be a foundation. A wall is measured by what it keeps out. A foundation is measured by what it allows you to build. And perhaps real security begins when the resources you fought to protect are finally allowed to support more than survival. They are allowed to support rest, connection, choice, time, presence, a life that does not need to wait for certainty before it begins. So the question is not whether you should stop preparing for the future. It is whether the future has quietly become a place where you store all the living you are afraid to permit today. If you recognized yourself in this, share what financial safety means to you, and subscribe for more explorations of the hidden psychology behind the habits we rarely question.